U.S. Federal Reserve is one of the most powerful organizations in the world. Today we'll be discussing how it's structured, what it does, and most importantly, how it affects you. So let's get to it. The U.S. Federal Reserve, often referred to just as the Federal Reserve or more simply the Fed, is the central bank of the United States. As such, it determines the monetary policy of the U.S., which is how much money is floating around in the economy and how it gets dispersed. The Fed has two major goals centered around controlling inflation and unemployment, which we'll discuss in more detail later. The Fed also has some major tools which it utilizes to achieve these goals. The Federal Reserve Organization was created by an act of Congress and reports to the U.S. government. It has three major components, including the Federal Open Markets Committee, the Board of Governors, and 12 regional banks. The Board of Governors is an independent agency of the federal government appointed by the president and oversees the system. The 12 regional banks oversee other commercial banks within their districts, and the Federal Open Markets Committee is made up of Board of Governors members as well as bank presidents, and it determines monetary policy of the United States. As stated earlier, the Fed has two main goals centered around inflation and unemployment. The Fed has a target 2% annual inflation rate and a 5% unemployment rate. These rates are seen as healthy for the economy and promote growth that is not too slow or too fast, which leads to other problems. There is some debate about these specific numbers, however, they are generally seen as healthy. Two of the major tools that the Federal Reserve uses to achieve its goals are through the Fed funds rate and the reserve ratio that it requires banks to hold. The Federal Reserve lends money to banks and as such charges them interest. This is known as the Fed funds rate. If the Fed sets a higher rate, it leads to less banking, as banks pass on those interest rates to their customers and they are less likely to borrow when the rate is high. This tends to slow down the economy. It reduces inflation, but it can increase unemployment in the long term. If the Fed were to lower rates, it leads to the opposite situation. More banking, a faster economy, it can reduce unemployment, but tends to increase inflation. The reserve ratio that the Fed sets for banks means that they need to keep a certain amount of deposits on hand for every dollar that is deposited. For example, with a 10% reserve ratio, if you deposit $100, the bank needs to keep 10% in reserve if you want to withdraw some money. Ergo, 10 bucks out of the 100. The bank is free to lend out the other 90. If the Fed moves this rate up, it means that there is less money to be banking. And if it moves the rate down, it means that there is more money to be banking. These are the Fed's two most effective tools for achieving its goals. However, there are some other tools that we'll discuss. The most prominent tool the Fed uses outside of the Fed funds rate and the reserve ratio are open market operations. This is when the Fed buys and sells securities on the open market. It is known as quantitative easing or tightening. If the Fed purchases securities, it increases the money supply as it generates new bank reserves because it just bought securities from the banks who now have cash to spend or lend out elsewhere in the market. This is known as quantitative easing. If the Fed sells securities, the reverse happens, and this is known as quantitative tightening. If the Federal Reserve turns a profit, profits are deposited to the U.S. Treasury. Before we get on to the last part of the video where we discuss how the Fed directly affects you and your wallet, if you enjoyed the content today, please go ahead and give us a like and consider subscribing to the channel for more content. As always, if you have any questions, comments, concerns, or requests for other topics, please go ahead and put those down below in the comments section. And now let's get on to how the Fed directly affects you. Anytime the Fed takes action, and sometimes when they don't take action, it affects you directly. Rate changes that the Fed makes impact the rates that banks charge you for mortgages, car loans, or any new debt you might want to take. But also if you have an adjustable mortgage, that rate can fluctuate based on the Fed funds rate. Additionally, credit card rates, retirement plan values, or the ability to take loans out against them can move up and down. And in the long term, we see changes in fluctuation in unemployment and inflation. These can be both positive and negative, but any move that the Fed makes will impact you in these areas. That means it can be easier or harder to get a job. You can start to make more money, though it might have less impact. Or the converse situation is also possible. Anytime the Fed undertakes open market operations, that affects the value of stocks, bonds, and anything else on the market that might be in, say, your retirement portfolio or even just a cash making portfolio on the side. So overall, when the Fed makes an action, You feel it, and it directly impacts you, which is why you should care about the Federal Reserve, and hopefully you have a better understanding of it after today and how it affects you. If you enjoyed today's video, we recently did a video featuring fixed income securities, aka bonds, and similar products that you might enjoy, so go ahead and click on that if you'd like it. Otherwise, if you enjoyed the video today, please hit that like button and consider subscribing to the channel. We'd greatly appreciate it and it would help us out. As always, questions, comments, concerns, or requests for other topics, please go ahead and put those down in the comments section. And otherwise, have a great rest of the day and thank you for watching.